Your target on the S&P 500 is still 3,100?
Yes, I think
it's about 9% from here.
Correct. I think that once we get visibility, PE expansion is, I think, really in play because we've had a pretty solid rally in credit that hasn't given up its gains this year, and we have the Fed really accommodative, and I think we are seeing sort of expansionary dynamics in the U.S. And so, yeah, a 16 PE on next year gets us to 3,100.
So what if you got a 16 PE though in your model? You've got to assume the earnings are going to stay steady or potentially grow. What makes you so confident in the face of not a slowing global economy, but a global economy that does have some risks to it right now?
Yeah, I think what a lot of viewers need to appreciate is that, roughly 60% of S&P earnings aren't really cyclical. They're not going to be sensitive to what's happening here in China.
60%?
Yeah, probably maybe even greater. And so they're really more tied to U.S. employment dynamics. That's actually still quite healthy. But more importantly, when you look at investment grade, you're paying close to 27 times to buy a bond from Apple, but you're paying 12 times to buy the stock. So there's a huge divergence between what you're paying for the credit and the equity of the same issuer. And so that convergence is what we're talking about.
What's the biggest risk then to the bull case? Is it trade? Is it something else?
An external shock is clearly the biggest risk right now. So it would be a level of escalation of trade that would topple us into recession. So trade tensions have escalated.
Yeah.
But the yield curve is steepened. The key one is 10-year, 30-year. That's actually dramatically steepened this year. So I don't think that fixed income and credit markets are saying a recession is imminent.
But do you worry that there's too much optimism that there'll be some kind of a peaceful and mutually beneficial resolution to the trade fight? Because everyone seems to say that, don't worry, it's going to work out. What if it doesn't?
Yeah.
What if this goes on for years? Then what?
Well, that's a fair point. I think the stocks have reflected some deep damage. You look at the semis, or you look at Baidu, or you look at Apple. These things have had huge retracements. So I do think that the market has priced in a lot of damage. But elevated tariffs, we just don't know what it does on demand. We know what the effect will be on CPI, but ultimately, I think there's practical considerations on the U.S. side. In 2020, equity returns in 2019 are going to have a big impact on the composition of political power next year.
What's the biggest bull case? We talk so much about the bear case because there's so many things out there to talk about, right? Brexit, the China trade fight, potential slowing economy, whatever. What's the biggest bull case for the market? What could send us even past your 3,100 target? Well,
I think there's just so much dry powder. Retail has been selling equities all year. We're talking they raised more than 10% increase in their cash balances. Hedge funds have been pretty skeptical of this rally, and it's hard to tell exactly where they're positioned, but when you look at prime brokerage borrowings, they're still kind of net short. So I think the equity market has a lot of cash on the sidelines. Any improvement in visibility, and like we're seeing hints of it this morning, plus the advanced decline line's been strong.
Dig into that just a bit. Remember, it's 5:35 in the morning.
Yeah.
Prime brokerage borrowing. So where big institutions would go to borrow stock to sell it short.
Yes.
So why does that data point perhaps signal a bullish thing for the markets?
Well, prime brokerage will measure, net cash will measure whether hedge funds are bullish, which means they have high borrowings, or they're kind of bearish, so they have cash. In a market that's up double digits year to date, where credit's actually held in really strongly, advanced decline line's strong, so probabilities favor an advance through the end of the year, hedge funds shouldn't be net short.
Okay. Well, I want to switch gears. Bitcoin. It's had a heck of a run.
Yes.
Heck of a run. But still well off 20,000. I mean, it was 20,000, and there was 4,000. Now there's 8,000, roughly.
Yep.
Where does it go from here?
Well, viewers need to keep in mind it's a hyper-volatile asset. We've published...
You think?
And it's negatively correlated with equities, which is good. But the top 10 days in any year account for all of the gains for crypto. So that's what we've seen, right? We've gone from
top 10 gains of the year.
Top 10 days.
Top 10 days. 365 days, 10 of them really matter.
Correct. If you take out the 10 best days each year for Bitcoin's 10-year history, you're down 25% a year. So you have to sort of hold this hyper-volatile asset. And, we saw it this month. It went from 4,000 to 8,000 really in just a span of a few days. But there's reasons to be optimistic. You know, it's proven to be digital gold. Like, you know, as we worried about China, we saw Bitcoin rally. There's this event called the halvening coming, which is the supply is getting cut in half. Bitcoin predictably rallies strongly the year before that halvening. It's exactly 1 year from yesterday.
Oh, 1 year. Okay, is the biggest bull case for Bitcoin the fact that the other cryptos, they're not all gone, but certainly Bitcoin is the Bran Stark of cryptos, if you will?
Yeah, it was a survival. It was Darwinism.
I hope I didn't.
Right?
Is it too soon to ruin the end of Game of Thrones? It was 36 hours ago, whatever. Is that?
No, I think it's appropriate. You know, Bitcoin is the dominant blockchain, and the survival of Bitcoin is a halo for the group. But yeah, you know, there's less interest in people buying these alternate altcoins this year.